Usually when you walk past a restaurant on a Friday night and like there's a huge line out the door.
Right, the lights are bright, everyone's laughing.
Yeah, exactly. You see all that energy and you just assume, well, business is absolutely booming. It looks like total success.
It does, but that is the ultimate illusion of foot traffic. What you see out on the sidewalk rarely matches the complicated reality happening on the actual balance sheet.
Oh, for sure. And we are jumping straight into that reality today for this deep dive. We've got a whole stack of documents in front of us, but the primary source we're looking at is the latest Form 10Q.
Right.
It was filed with the SEC by Kura Sushi USA, Inc. for the quarter ended May 31st, 2026. So pretty recent stuff.
Yeah, and for anyone tuning in who, doesn't spend their weekends reading SEC filings.
Which is most people, hopefully.
Right, exactly. A 10Q is just a mandatory financial health check.
Yeah.
Public companies have to publish them every single quarter. It basically forces a company to pull back the curtain.
Yeah, to show you and me exactly where their money's coming from.
And crucially, where it's all going.
Right. So our mission today, right, is to uncover how a really highly specific, technology-enabled, fast-growing restaurant concept is trying to balance things. Like, they have this breakneck physical expansion on one hand, but they're facing some massive macroeconomic hurdles on the other.
It's a really delicate balancing act.
It is. I mean, we're looking at a company fighting global inflation, international tariffs, and, a consumer who is increasingly holding onto their wallet a little tighter these days.
Definitely. But to really understand the financial mechanics of all this, we first have to understand what Kura Sushi actually is.
Because it's not your standard spot.
No, not at all. This is not your neighborhood mom-and-pop sushi joint. They market something they actually call the Kura experience.
The Kura experience, yeah.
Right, which is this fully technology-enabled, authentic Japanese dining model.
And the centerpiece of that, like the thing everyone knows them for, is the revolving sushi service.
Oh, yeah, the conveyor belts.
Yeah. It's so fun. Little plates of sushi travel around the entire restaurant on this two-tier conveyor belt system. You literally just grab what you want as it passes by your table.
Or you could order directly from an iPad at your table, and the food just shoots out to you on a specific express belt.
It's basically a ride for your dinner. But underneath all that entertainment factor, there's a very rigid, highly automated operational model.
Highly automated.
Right. And that model has been expanding at just an incredible rate. I mean, if we look at the top-line sales numbers, for the 3 months ended May 31st, 2026, sales hit $85.9 million.
Which is huge. That's a 16.2% increase from the exact same period in 2025.
Yeah. And if you zoom out to the 9-month period, sales were $239.4 million.
Up almost 18%.
Right. But let's look at the engine that's actually driving that revenue, because it is pure physical growth. I mean, in just the 9 months leading up to that May cutoff, they opened 12 new restaurants.
12 in 9 months. That's aggressive.
Very. And that brought their total footprint to 91 restaurants spread across 22 states and Washington, D.C.
And the filings actually note they opened 3 more locations immediately after the quarter ended. So they are aggressively planting flags everywhere.
Yeah, they are.
And they're doing it using a really specific intellectual property setup, which is interesting. Kura Sushi USA is actually majority owned by a parent company, Kura Japan.
Okay, so they're essentially a massive subsidiary.
Exactly. And the relationship is super heavily integrated. So Kura USA pays a 0.5% royalty fee to Kura Japan based on their net sales.
Just right off the top.
Right off the top.
Yeah.
And that fee grants them an exclusive license for the trademarks, sure, but more importantly for the patents. They also buy their physical kitchen equipment and those custom conveyor belts directly from Kura Japan.
Okay, let's unpack this, because those patents are really the secret sauce here. I mean, I think it's their technological moat, right?
A technological moat is a great way to describe it.
Yeah. The filings specifically mention their food management system and something called the Mr. Fresh Protective Dome. And my reading of this is that the Mr. Fresh Dome isn't just a plastic lid to keep a spicy tuna roll from drying out on the belt.
Oh, it's far from it. It's actually brilliant. The Mr. Fresh Dome system integrates with microchips on the plates themselves and sensors all along the conveyor belt.
Wait, really? Microchips in the plates?
Yes. So when a chef places a plate on the belt, the system logs the exact time it was made. And if that plate circulates past its prime, the system automatically alerts the kitchen to pull it off the line.
Wow, so that drastically reduces food waste, I imagine.
Massively. And furthermore, the customers don't even have to touch the lid. You just lift the plate slightly, and the dome pops open automatically, so it marries, hygiene with highly precise inventory tracking.
That is wild. It basically transforms a traditional restaurant into a data-driven manufacturing assembly line.
That's exactly what it is.
But, I have to look at these glowing revenue numbers and play the skeptic for a second.
Please do.
If you aggressively sign leases and open 12 new doors in 9 months, well, of course your overall revenue goes up. You just added a dozen new cash registers to the mix.
Right, the top line has to go up.
So my question is, are people actually eating more sushi at their existing tables, or is this just the illusion of growth created by, pouring more concrete and opening new stores?
This raises an important question, and honestly, it's the exact tension we need to explore today. Because when we strip away the new stores, the reality of their baseline performance shifts pretty dramatically.
I figured it might.
Yeah. To see that, we have to look at a metric called comparable restaurant sales. You'll hear this called same-store sales a lot. Basically, this metric only counts locations that have been open for at least 18 months.
Okay, so that strips away all the grand opening hype. The honeymoon phase is over, the lines die down, and we see the true, stabilized baseline of the actual business.
Exactly. And in the third quarter of 2026, those comparable restaurant sales actually decreased by 0.4%.
Wow. Okay, so the established core restaurants are actually shrinking.
Yes. And to understand the consumer psychology behind that fractional drop, we have to split that metric into its two raw ingredients:
Which are?
guest traffic and ticket size, which the report refers to as price/mix. So guest traffic, meaning the actual number of individual people walking through the front door to eat, that dropped by a very significant 5.1%.
Oh, wow. A 5% drop in physical bodies. That means empty tables. It's less energy in the dining room.
Exactly.
But wait, if foot traffic dropped by over 5%, why didn't the revenue for those stores drop by 5%?
Because the drop in physical traffic was almost entirely offset by a 4.7% increase in the price mix. Basically, the people who did show up paid significantly more for their meal.
Man, it is the classic treadmill of restaurant price hikes. You lose customers, so you squeeze the remaining loyal customers a little harder to make up the difference.
It's a dangerous cycle.
Yeah.
And Kura explicitly attributes the drop in foot traffic to lower consumer spending tied directly to the macroeconomic environment.
Right, people are just feeling the pinch.
Yeah, their budgets are tightening. And, grabbing sushi on a random Tuesday night just gets cut from the family budget.
Makes total sense.
And the company's immediate reaction to that consumer pullback was to lean on their pricing power. So they raised menu prices in the first quarter of 2026, and the filing actually notes they had another price hike planned for July 2026.
Which brings me to the fundamental math of a restaurant, right? If you are charging the customer an extra 4.7% for that exact same plate of salmon, where is that extra cash actually going?
Right.
Like, is it just padding the profit margin, or is it literally costing Kura more to put that plate on the revolving belt in the first place?
Well, this brings us to a fascinating tug of war detailed in the margins of this 10Q. We see a direct collision between their food costs and their labor costs.
Okay, lay it on me.
The bad news hits the food side first. Food and beverage costs rose to 30.2% of their total sales. That's up from 28.3% the previous year.
Oof. A nearly 2% jump in food costs is brutal, especially when restaurant margins are already incredibly thin to begin with.
It is. And the filing lays out a combination of culprits for this. A primary driver is tariffs on imported ingredients, alongside just general commodity inflation across the board.
Got it.
And they point out that this cost increase happened despite the termination of IEPA tariffs.
Right, and if you aren't familiar with IEPA, it stands for the International Emergency Economic Powers Act. Essentially, it just allows the government to impose emergency trade sanctions or tariffs.
Exactly.
So the report is basically telling us that even though certain emergency tariffs ended, the baseline cost of raw materials just stayed stubbornly high.
Because the global supply chain was already so bruised.
Yeah.
Furthermore, the company explicitly notes that ongoing geopolitical events are threatening energy supplies and just generally disrupting global food distribution markets.
Yeah, that makes sense. If you run a business that relies on highly specialized Japanese ingredients and global shipping lanes get congested,
Or fuel prices spike.
right, fuel spikes, getting that product to a location in the American Midwest becomes very, very expensive.
Incredibly expensive.
So the cost of the physical sushi is spiking because of massive global forces entirely outside the company's control. But earlier, you hinted that the labor side of the equation tells a completely different story.
It does. And this is the operational paradox of this 10Q. While global Food costs really dragged them down. Labor and related costs actually dropped.
Oh, really?
Yeah, they fell to 30.6% of sales, down from 33.1% the year prior.
Okay, I am looking at a modern economy where literally every headline is about wage inflation, union drives, and how incredibly expensive it is to staff a retail business right now. How on earth does a massive restaurant chain lower their labor costs by 2.5%?
Well, the report acknowledges they are indeed facing low single-digit wage inflation. So they are paying their employees more per hour.
Okay.
But they beat the inflation anyway through operational initiatives. They leaned incredibly hard into their tech-driven reservation system and optimized employee scheduling.
Okay, here's where it gets really interesting. Think about how that reservation app actually functions on the floor of a physical restaurant. By forcing customers to queue up virtually on their phones.
So everyone does now.
Right. Kura eliminates that chaotic crowd at the front door, and that means they don't have to pay a hostess 15 or 20 bucks an hour just to stand at a podium and manage a wait list.
The technology isn't just a novelty, right? It is a direct mechanism for labor reduction. When a customer sits down, they grab food off the belt or they order on an iPad.
Right.
So the human servers aren't taking complex orders or running back and forth to a POS system to punch things in. They're primarily just bussing tables and delivering drinks.
It is brilliant. It's like Kura is out there on the open ocean getting battered by these uncontrollable global forces like geopolitics and international supply chain breakdowns, but they are fighting back and actually winning on the hyper-local level.
Yes, exactly.
They are using app technology to literally strip human hours out of the transaction. The iPads and the conveyor belts are paying for the spike in global fish prices.
What's fascinating here is how Kura utilizes its core identity to shield itself from macroeconomic volatility. I mean, optimizing the labor they do have allowed them to find a 2.5% margin saving, which, neatly offset the nearly 2% loss they took on the food side.
So they basically balance the daily operations.
Pretty much.
But, operating a single restaurant efficiently doesn't explain the reality of building a massive corporate empire.
Yeah.
We need to transition from the daily operations to the heavy, long-term financial reality of this business.
Right, because growth isn't free.
Exactly. An iPad saves on hourly labor, sure, but physical expansion requires millions of dollars in concrete and steel and real estate.
And the cost of scaling is where the bottom line reveals a completely different narrative than the top-line revenue we talked about.
Let's hear it.
So we discussed that massive $85.9 million in sales for the third quarter, right?
Yeah.
The actual net income for that exact same three-month period was a razor-thin $423,000.
Oh, wow. Wait, so they generated $85 million in revenue and kept less than $500,000 in profit.
Yes. And if you look at the broader 9-month period, despite pulling in almost $250 million in sales,
Well, $250 million, yeah.
they actually operated at a net loss of $4.3 million.
That is staggering. So the immediate question is, where on earth is all the cash going?
Well, the 10Q provides the answer pretty clearly in the capital expenditures. Over those 9 months, KRUS spent $43.3 million on property and equipment purchases.
So they are taking every single dollar they make and then millions more on top of that and plowing it directly into construction, kitchen equipment, and, setting up new revolving belts.
Exactly. Building a physical empire drags heavily on several lines of the balance sheet. For example, their occupancy costs jumped 20.5% in the third quarter alone.
Just on rent.
Well, a massive portion of that is pre-opening lease expenses.
Right, let's explain the mechanics of that for a second. When a company signs a lease for a new restaurant, the landlord doesn't care that your kitchen isn't built yet.
They want their money.
Exactly. Kura has to pay monthly rent on an empty shell of a building for, 6 to 9 months while they undergo intense construction and install all those custom conveyor belts.
Long before they can sell a single piece of sushi to cover the cost.
Yeah. It is literally like paying 2 mortgages at the same time.
It really is. And then you add to that the depreciation and amortization expenses, which hit $12.7 million over the 9 months.
Right. And for anyone rusty on their accounting terms, depreciation is just a way of spreading out the massive cost of a physical asset over its useful life.
Right.
Like you buy a $1 million conveyor belt today, but on the balance sheet, you deduct a portion of that cost every year as the machine slowly wears out.
Exactly. Now, beyond the heavy construction costs, the filing also records some legal baggage, which dragged on the numbers.
Oh, what kind of baggage?
They recorded a $0.9 million settlement, which is currently pending court approval. And this stems from a California wage and an hour class action and a Pagaga notice filed by a former employee.
Ah, okay. If you don't live in California, PAGAS stands for the Private Attorneys General Act. It's this really unique state law that basically deputizes a single employee to file a lawsuit over labor code violations, not just on behalf of themselves, but other aggrieved employees and the state of California itself.
It's powerful.
Yeah, it can turn a minor dispute into a very expensive headache for an employer really fast. So nearly $1 million went out the door just to settle a labor dispute.
Yep. And all this aggressive expansion in cash burn also creates a fascinating tax positioning, which is very revealing about how management views their own near-term profitability.
Okay.
Management placed a full valuation allowance against their net deferred tax assets.
Okay, let's break that down because it sounds like a very dense accounting riddle.
It does.
Think of a deferred tax asset like a coupon from the government. It allows you to lower your future tax bills, usually because you took a financial loss this year.
The catch, though, is that accounting rules dictate you cannot simply list that coupon as an asset on your books unless you genuinely expect to generate enough future profit to actually use it.
Right, you have to be able to cash it in.
Exactly. And because Kura has been running at a cumulative loss due to all this aggressive expansion, the accountants basically required them to place a valuation allowance on it.
Got it.
In plain English, they had to put a giant asterisk next to that asset, admitting, hey, we likely won't be profitable enough in the near term to utilize those tax benefits.
Oh. While we are on the subject of taxes, I noticed the filing includes a note about a broader macroeconomic tax shift.
Oh, right.
It references the passage of the One Big Beautiful Bill Act, or OBBA, in July 2025. Now, just to be clear for you listening, we are strictly looking at the financial mechanics here, not the politics of the legislation itself.
Right, just the numbers.
Yep. The OBBA was a major reconciliation tax bill that restored 100% bonus depreciation and reinstated expensing for domestic research and experimental expenditures.
Right, and the critical takeaway from the 10Q on this is that the OBBA had absolutely no material impact on Kura's effective tax rate or their income tax expense for the periods covered.
None at all.
None. While the legislation altered the corporate tax landscape broadly, it just didn't move the needle for Kura's immediate financial picture, largely because of that net loss position we just discussed. They aren't paying income tax right now anyway.
That makes sense. So let's summarize the immediate reality here. They are burning cash, they're operating at a net loss to rapidly expand their physical footprint, and they're managing legal settlements.
Correct.
If they are spending $43 million on equipment while running a net loss, what happens if they literally just run out of cash to build the next restaurant?
Well, their ultimate safety net is their parent company. The filing shows they maintain a $45 million revolving credit line with Kura Japan.
Okay, that's a nice safety net.
It is. They actually recently extended the maturity date on that facility out to 2028.
Yeah.
But crucially, as of this filing, there are 0 borrowings on it.
Wow.
The entire line of credit is just sitting there untapped. So if we connect this to the bigger picture, Kura is executing a classic, albeit highly aggressive, growth stage strategy.
They're in pure growth mode.
Exactly. They are completely comfortable operating at a paper loss right now. They are purposefully pouring their operating cash flow into physical infrastructure to secure long-term market share.
Right.
Management clearly believes capturing the prime real estate and establishing the brand footprint today is worth the near-term hit to net income.
I hear that, but I am going to challenge the long-term viability of that pace.
Fair enough.
I mean, they have a massive safety net with Kura Japan, sure, but with tens of millions flying out the door for construction and pre-opening leases, is this velocity actually sustainable if the consumer keeps pulling back?
That's the risk.
Right. We established earlier that physical foot traffic at their existing stores dropped 5.1%. You cannot justify building a dozen new restaurants a year if the dining rooms are slowly emptying out.
That is the defining tension of their current business model. They are racing to expand a physical footprint based on past demand, while the current data suggests the consumer is retreating today.
Yeah.
If consumer spending retracts further, that massive cash burn rate for construction is going to look much more dangerous, even with a $45 million credit line backing them up.
Exactly. Well, that brings us to the end of today's deep dive. Let's do a rapid-fire recap of what we've unpacked from this Kura Sushi Form 10Q.
Let's do it.
We are looking at a company that successfully uses a high-tech, low-labor model to rapidly expand a really unique dining experience across the country.
Huh?
But they are walking a serious financial tightrope.
A very thin tightrope.
Oh,
They are actively offsetting a significant drop in physical foot traffic by aggressively hiking menu prices. They are battling massive global supply chain tariffs on their raw ingredients by leaning heavily into local scheduling technology to slash their human labor costs.
which is wild.
And they are doing all of this while burning through millions in cash to physically build new locations at a net loss.
So what does this all mean for you? Whether you are evaluating a business to invest in or, just trying to understand the economic shifts in your own neighborhood, the ultimate takeaway is that glowing double-digit revenue growth does not always mean a company is in perfect health.
Never take it at face value.
Exactly. You have to look past the top line. You have to look at the same store sales to see if real people are actually showing up. And you have to understand the tension between what it costs a company to physically expand versus what they are saving through operational technology.
And that tension leaves us with a final, slightly provocative thought to consider today.
Oh, I love these.
We've seen that Kura relies incredibly heavily on tech-enabled scheduling, automation, and these automated conveyor belts to basically remove human labor from the equation.
Right.
It is the core mechanism of how they survive global inflation right now. But how far can a restaurant push those menu prices up to fight food costs before the consumer ultimately balks?
That's a great question.
At what price point does a customer feel like they are paying a premium luxury price for a fundamentally automated, humanless experience?
Oof. That is the million-dollar question right there. Because just because the lights are bright and the restaurant is packed doesn't mean the balance sheet is comfortable. Next time you see that line out the door, remember the complicated mechanics running underneath it all. Thanks for joining us on this deep dive. We'll see you next time.